The artificial intelligence hardware market is receiving billions in capital, but a quiet skepticism is beginning to spread among investors. They're starting to ask exactly when these heavy infrastructure spends will generate actual, sustainable revenue. In a space this crowded, virtually every startup arrives with a pitch deck claiming their new architecture is the absolute fastest on the market. The sheer volume of these claims has rendered standard laboratory benchmarks nearly useless. This chart shows the valuation trajectory of an AI chip startup called Etched. Over a window of just 30 days, their valuation spiked from $10.3 billion straight to $21 billion. That specific leap was locked in by a single $700 million injection of fresh capital. Theoretical math on a whiteboard does not double a $10 billion company's worth in 4 weeks. A valuation jump of that scale requires hard, undeniable proof that the technology actually works in the wild. What makes this funding round unusual is the source of the money. The lead backer wasn't a traditional Silicon Valley venture capital fund. It was a highly secretive quantitative trading firm. That check came directly from Jane Street. To understand why a Wall Street firm just placed a $700 million bet on unproven hardware, we have to look at what exactly they saw when they put Etched's chips to the test. Inside quantitative trading firms, human traders don't execute individual orders. Instead, autonomous algorithms analyze market conditions and fire off thousands of automated trades a second. In that environment, a processing delay of a single millisecond can cause an algorithm to miss a fleeting price discrepancy, resulting in millions of dollars in lost profit. The point of friction is inference, the moment an AI takes live data and instantly decides what action to take. General-purpose chips are built for broad tasks, meaning they struggle to keep up with the split-second inference demands of a live trading floor. Solving that specific processing bottleneck guarantees an efficiency advantage. That is why firms like Jane Street deploy substantial capital to hunt down highly specialized hardware. When Etched approached them, Jane Street bypassed the theoretical benchmarks entirely. They acquired the actual physical server racks to test the hardware themselves. They plugged those chips directly into their own proprietary network, routing live, high-volume quantitative tasks through the new architecture to see if it would break under the load. The hardware held up. Etched systems process the data at ultra-high speeds, handling the exact workload that chokes standard processors. Jane Street immediately placed a direct order for the systems as a customer, and then used that internal validation to lead Etched's $700 million funding round. In venture capital, there is no stronger signal of product-market fit than an enterprise client testing a product, buying it, and then investing in the company itself. That sequence of events is exactly what justified doubling Etched's valuation overnight. Etched now operates with a rare stamp of approval, backed by some of the most rigorous capital on Wall Street. This marks a departure from the previous phase of the AI boom, which favored general compute chips designed to train large-scale models. Etched's funding round points to a specific pivot. Investors are increasingly placing a premium on inference execution over model training. This requirement for high-speed inference extends to global AI consumer products, where user experience depends on how quickly a model can respond to a prompt. We are seeing rapid rollouts of consumer models that require complex real-time processing and safety guardrails, like OpenAI's new ChatGPT tier for teens. At the same time, platforms like Reddit are testing features that use AI to instantly generate narrated video content from a stream of raw text posts and comments. As these AI tools scale to handle billions of daily interactions, the demands on processing speed will only intensify. The winners of the hardware race won't be decided by whiteboards, but by the companies that can survive the ultimate real-world stress tests.